Shayne, you have been through a few financial crises in your time. You've done nearly 4 decades in banking now. You look at this one, you don't see it as another crisis. You've sort of been cautiously optimistic about how it's going to play out. Well, why?
Well, I think it's probably a matter of words and descriptions. Interesting, in preparing for some of the things I've been doing with customers recently, I just had a quick look online. It's interesting, over the last 250 years, there's been 39 financial crises of some shape or form, right? So on average, they're every 6 or 7 years. And I remember when I first started in banking in the 80s, that was a rule of thumb we were all taught. Hey, every 5 to 10 years, there's something going on in the world. And so we shouldn't be surprised in a funny way that things like this happen. It's too early to call it it's a crisis for some, obviously, but is it a financial crisis in the typical? Who knows? Does it have the potential to be one? Yes, it does have the potential to be one. My comments are really more about the fact that I think a lot of people leapt to a conclusion or leapt to an assumption that this is another GFC, and I think that's way too early to make that analysis. And the reason is that the real causes are quite different. It's like that old saying, that history doesn't repeat, but it rhymes. So there are lots of rhymes here that we can see in previous turmoils or crises, including the GFC. But actually, when you really get the microscope out, the causes and what's going on here are really, really different than the GFC. GFC was fundamentally a crisis around the quality of assets and the loans that banks were making. That's not what the risk is here. This is a different issue. This is really to do with the global war on inflation and how central banks are raising rates very quickly in order to combat that, and that has casualties. And so actually, if anybody from an historic point of view is looking, and you all have your own opinions, probably the one that it rhymes with the most in my lifetime is the savings and loan crisis, which was in the sort of mid-80s through to the early 90s in the US, which again was driven by something very similar when rates were rising quite heavily, and it sort of exposed a lot of poor businesses to that risk.
And that is it's a fundamental underlying cause, isn't it? For 20 or 15 years or so, we haven't had a rising rate environment. In fact, we've had money at near zero, free money. So even if interest rates normalise, it's going to be much tougher. So we're going to see, I suppose, these first order effects. We've had some bank casualties. The second order effects presumably are funding for banks and liquidity in the system, and then it plays out into the real economy in terms of higher funding costs. So how do you sort of understand how it might progress?
Yeah, no, that's exactly right. I mean, the sad reality, as I mentioned, the world, particularly the Western world, is at war with inflation, and we know why, because inflation is an insidious thing that really does harm, people in the community, and so it's right to take that very seriously. And of course, the way that we structured our economies today, which I totally understand and support, is that central banks are in charge of that war, and they have limited weapons, and interest rates being the tool of choice and obviously the most impactful. When you see such a rapid rise in rates, and it's to do with the speed and the degree, it's very hard for those in the community, businesses and households, to adjust, because that really has an impact on cost of living, taking money out of their pocket, and not everybody can adjust so quickly, and those that can't typically fall over. Whether that's about sadly losing their job or potentially not being able to continue their business. So there's always a casualty in these events. Of course, the regulator and governments are trying to sort of limit the blast radius, if you will. They're not intentionally trying to cause harm, but it's inevitable, and they're trying to do their best to limit the damage so that lots of people have a small amount of pain as opposed to a small number of people have lots. But inevitably that's sort of a policy issue, and the difficulty is when you're raising rates, it's hard to know. It's hard to know who out there is going to be exposed or who's going to struggle. But to your question, if in a simplistic sense, what you're seeing here is liquidity, which has been abundant for a number of years, is now less abundant. And in that, so liquidity dries up, two things happen. It becomes more expensive for those who can get it, and not everybody can get it, so it becomes rationed. So in that event, the real question is, who are those businesses and households potentially really dependent on that liquidity availability? Who are they? And who are the people who can't afford the higher cost? So in this current round and what we've seen in the US, and just keeping it there for a second, there are different commentators and different data points, but it would appear that the cost of liquidity, the cost of raising short-term money, has risen somewhere between 1% and 2%. Call it 1.5%. One of my directors the other day said, let's call it 1.5%. It's the equivalent of the Fed having raised another 1.5%. It's the equivalent of not having, 4.75% sort of target rate, but actually 6.25%. Wow, so that gives you a sense of the dimension of what's happened here. So of course there are going to be casualties. Nobody imagined it was going to be the 16th largest bank in the United States and some others. And so look, Andrew, I would, that liquidity impact does affect initially the banking sector, because we're the transmission mechanism for that, but ultimately it affects the real economy, to use your words, and that's true. And what that will mean is that businesses, households, small and big businesses, will have to pay more to access funding, and potentially that funding will get rationed and not everybody will be able to have some. And so that'll have real impacts. And we can talk about, historically, it's really those people who are overgeared, who have too much debt, or who have a business model where when their cost of goods go up, the cost of money goes up, they're unable to pass that on to their own customers. And those are the people that are most at risk in this environment.
And if we look at what's happening, on capital markets more broadly, it does look like the contagion has been contained somewhat. It also looks like that we may be near the top of the interest rate raising cycle, even though things might change. So we say, okay, well, maybe the acute phase of this tension is nearing, but these other phases that we're talking about, the sustained higher rates of interest, the sustained demand for liquidity that might not be there, are we talking about something that plays out now over months or years?
So again, history isn't always a good indicator, and things are always different. And I think some of the key differences this time, the regulators have, and governments, but regulators have learnt a lot, right? They learnt a lot during the GFC, and you've seen that in the last week or so in Europe, and you've seen it in the United States. That really, the ability for regulators to come in with a sort of overwhelming force really quickly to resolve a situation, to calm the markets down. I mean, the regulators have acted much more profoundly than they did in the GFC through that learning. So that's different this time. It's also that the starting point is different. I mean, if you just look at the strength of the economy, or the strength of the banking sector, or the strength of corporates and households, they were much stronger today than they were going into the GFC. I mean, going into the GFC, remember, there was a high degrees of leverage sitting in the system, whether it was household or businesses, etc. That's not the case this time. In fact, but for the things that have happened in the last few weeks, the core economies in the developed world in particular, and in developing world, are really strong. Unemployment, pretty universally is at, 50-year lows around the world. People have jobs. Pay is, people are having high pay. Actually, household balance sheets, and let's talk about Australia. We know that household balance sheets here, people have a lot of household debt relative to the rest of the world. But actually, in real terms, when you look at the total of their balance sheet, they're in better position today on average than they were going into the GFC, and it's the same for corporates. So starting point's better. Regulators have learnt a lot, and of course regulation has been tighter for banks as well. So banks have also got more capital than they did before and more liquidity. So that should suggest that the impacts of this will be less. Having said all that, it's clearly not over. I don't think you can sit here and say, well, that's all done, and Silicon Valley Bank and Credit Suisse, and life will go back to normal. These things tend to roll through over a long period of time, and as I started my comment, history says it'll take many, many months, if not a year, for these things to roll through the economy. Before we started recording, we were chatting about the GFC. Everybody will remember, to some extent, roughly when the sort of Lehman Bear Stearns thing happened. But that was it was actually a year before then, when the first tremors came through, when some of the money market funds in the United States started breaking the buck, failing and not being able to be worth, 100 cents on the dollar. And again, we managed through that, and sort of things muddled through, but it was a year later that this real sort of crisis emerged. Now, I'm not suggesting that we're going to have that crisis, but it's really early days, and people will be on full alert, monitoring the situation over the coming months.
And we're sitting here in Melbourne. Obviously, the Australian banking system came through that GFC as well as really any economy in the world. So I don't know whether there's complacency in Australia about what's going on, but ANZ's the most international of the Australian banks, so that, for better or worse, that means you deal with a lot of regulators in the region. What's the sense you get from those regulators about the broader region and the broader global situation?
Yeah, so I think, having that diversified business is a strength actually, and a little bit like, and again, I hate to compare it, but even when we were going into COVID, having that international network meant that we were far more aware of things happening and were able to learn and adapt much more quickly than we might have been if we were only had a domestic business. So I think it's the same here. So ANZ itself has actually learnt a lot through the GFC and the Royal Commission, and we've been on a path of really de-risking the bank ourselves. But the other thing that's really worth noticing, and we operate in 30 markets around the world, including all the big money centres, is the transmission of information, the sharing of information, the collaboration, the alignment between regulators. Even though they're all different and they have different ambitions and strategies and priorities, it's much closer than it was even in the GFC. That was another learning, so that there's more coordination, sharing of information, etc. The data flow, we kind of take it for granted now, but the instant nature of real-time data around the world is far greater than it was at any other time. So those things are generally good if regulators and banks are able to act on that information in real time, and I'm pretty confident that that's the situation. I do think it's worth pointing out, and again, just like it was in the GFC, but perhaps even more so now, the Australian system is different. And there are lots of things that are the same globally in terms of the way that banks run, but there are a lot of things that are different. And the differences really come down to the much more stringent controls and regulation we have about the amount of capital that we have, which is really, really important, about the amount of liquidity that we hold, which is really where these issues are emerging at the moment. So we have much more stringent calculations there, and actually just some of the boring stuff, but the way we do our accounting, and the way we mark things to market, and the way we bring those things to account is far more stringent and beneficial from a depositor or shareholder's point of view, and for the whole economy, than it is elsewhere in the world.
Well, just to finish on that point then, from the ANZ perspective, are you comfortable with capital, with liquidity, with the risk settings? Are you revisiting these metrics?
Absolutely, you revisit them all the time, and when you do so, and all that happens now is the frequency of that revisiting is increased. I mean, ultimately all those things are great, and I'm very comfortable with the way that we've set, but there's no complacency whatsoever. Again, I think one of the real benefits, one of the real strengths of an organisation like ANZ is that international perspective, but actually it's the experience of the management team. And you started by saying, I've been here almost 40 years, which makes me feel very old, and having had a global career. But I look at my team and I think about the experience we have in the team and the people running the institutional bank, our chief risk officer, our CFO, et cetera, et cetera. These are people who have had global careers, and the reality, the nature of banking, as I started, the reality of the financial markets is there's always something going on. They're always a bit different. And every time you go through one of those, if you're smart, you learn. Don't get everything right, but you learn and you're able to adapt. And pretty early on in these new sort of issues that are arising, we as a team just get together really quickly. We're meeting every day. We're looking at our data more in real time, and of course you make adjustments. So we've dragged out a bit of a framework that we use, funny enough, in COVID to sort of organise the work and make sure we're focused. So something we developed, which I think has worked really well. There's a 4-point plan, and people like 4 or 5-point plans, but the 4 points sort of protect, adapt, engage, prepare. So protect. First thing we've got to do is protect the bank, our balance sheet, make sure we can continue to operate, liquidity, capital, protect our people, look after our customers. Adapt to the new world. Liquidity is harder to come by. It's more expensive. Right? Our customers have different needs. We need to adapt. Just like we had to adapt to working from home, we have to adapt to this new world of capital markets. Engage. We have to engage. Our people are asking more questions. Our customers are certainly asking more questions, what they need to do, what does it mean for them, our regulators and the community. So we're increasing the level of engagement, doing things like this, playing our role and trying to make sure that the community is better informed about these things, and then prepare for the future. So just like COVID, the world never went back to the way it was pre-COVID. Even with these things that are happening, and who knows where it'll go, the future will never go back to the way it was. It'll always be slightly different, and so we need to prepare for that new world. And I imagine, it's too early to say, but as a result of this, I can almost guarantee that regulators around the world are thinking of new things they need to put in place to protect depositors and the economy from change going forward. And so there'll be a whole bunch of things that we need to prepare for.
Well, thanks very much for your time, for that perspective, that pretty unique perspective. So thanks, Shayne, for your time.
Thank you.